Hello friends, good to see you. You might be wondering what are the best mutual funds or the stocks to start your systematic investment plan SIP. I am Govind here. In this video, I am going to discuss about the top 5 reasons why SIP with ETFs is much better than the mutual funds SIP. Before we understand the top 5 reasons, let us quickly understand what are the ETFs and what are the mutual funds. In my previous videos, I have already explained in detail about the ETFs. Just to give a quick recap, ETFs are nothing but the exchange traded funds. There are ETFs for gold, there are ETFs for index like Nifty, Bank Nifty, etc. The index ETFs simply emulates the index with the same weightage of the stocks in the respective index. That means whenever you are buying a Nifty B, a Nifty ETF, it actually represents the value of the Nifty. All the index ETFs are the equity instruments. They are listed in the exchange. You can trade them like any other stocks. You can buy and sell at any time. Coming to the mutual funds, these are nothing but the funds that are managed by the particular companies. Those companies are called the fund houses. For example, HDFC or ICICI or SBI, these companies, the fund houses, collect the money from many investors and they invest into set of stocks on behalf of the investors. The mutual funds are again the equity instruments. There are various types of funds. You have mid cap, large cap, sectorial, etc. And again, there are closed-ended funds and open-ended funds. And you also have the systematic investment plans for the mutual funds. SIP is one of the most preferred way of investment. That is because you can invest a small amount of money regularly instead of investing huge money at once. And also your average buy price over a period of time will be lower compared to investing at once. Let us now look at the top 5 reasons why SIPs with index-based ETFs is much better than the mutual fund SIPs. The number one top reason is the cost of fund management in case of mutual fund is quite high. It includes the employee cost, advertisement cost, etc. But whereas in case of ETFs, the operational cost is quite low. In fact, there are no advertisements that come to buy any index-based funds like NIFTYBEES or BANKBEES, etc. The second reason is the hidden fees. Some of the mutual funds do have the hidden fees like entry load, exit load, etc. But in case of the ETFs, there is absolutely no hidden fees. Whatever the price that you buy or sell is the price that you get it. The next top reason is the drawdown. Drawdown is nothing but the amount of value or the NAV value that goes down when the market goes down. In case of mutual funds, the drawdown are normally higher compared to the ETFs. That is because the performance of the mutual funds is heavily based on the set of stocks that the fund house might have picked up. But whereas in case of ETFs, these are being managed well by the set of people, the drawdowns are normally quite lesser. So when the market is down, if you want to withdraw the money from the mutual fund, you may end up losing more money compared to the ETFs. The fourth top reason is the lack of liquidity in case of mutual funds. Whenever you want to redeem your units from the mutual fund, sometime it takes few days or even 1 week of time to get your money credited to your account. In fact, some of the mutual funds do have the lock-in period. But whereas in case of ETFs, you can simply sell your units from your trading account. Money will get credited by T+2 days. It is like selling any other stocks. The fifth top reason is that mutual funds have too many schemes to select. It is very confusing to select which fund to invest. But whereas in case of index-based ETFs, it is quite simple. You can pick any of the indices, especially the Nifty, which consist of most of the sectors like IT, bank, pharma, consumer, auto, all these are part of the Nifty. And in case if you are very particular, or if you think there is a particular sector that will do well, you can also pick, like you can pick IT index, you can pick pharma ETF, you can pick bank ETFs. This is also possible with ETF. Friends, you may now ask two questions. What are those ETFs that are available, and how is the performance of those ETFs? Here is the top ETFs that are available for you to look at. One is the NIFTYBEES, which represents the Nifty 50, and BANKBEES representing the BANKBEES. PharmaBees represents the pharma sector. ITBees represents the IT sector, and ConsumeBees represents the consumer sector. So friends, based on your interest, based on your evaluation, simply pick any of these ETFs and start investing month by month a small quantity. Especially when the market goes down, you can pick quantity that you would like to and keep investing month on month. So this will give you a better return and you have a better control on your investments. I have selected the Nifty B here, and from 2010 to 2022 October, that is till today, it has given 275%. So the best thing to do the SIP is every month when the market falls, keep buying the NIFTYBEES. That will be your SIP. So like that, you can also see the performance of the Bank Nifty. Bank Nifty from 2010 to till now, it has given 428% return. Friends, like this you can see the performance of the ITBees, ConsumeBees, AutoBees, etc. Considering all these factors, it does make sense to consider at least some portion of the capital as an SIP into ETFs. You have a better control on your investment, and also you can buy them, you can sell them at any time, and the drawdowns are less. Once you have the one lot of Nifty B or Bank B, you can start doing the covered call strategies to generate a additional rental income. There is a separate video explaining how to do a covered call strategy with ETFs. The link is given in the description below. You can take a look at it. Friends, I hope you learned something out of this video. If so, do press the like button and also subscribe to this channel. Thank you for your time. See you soon.